In this study, we investigate the use of the ratio of the U.S. central bank balance sheet to USM2 money supply as a possible indicator for Fed policy change. Context. The central bank balance sheet is a measure of the obligations of the federal government to service its debts. USM2 is a measure of the available liquidity in the system that might be used to service debts. So the ratio of the two could be considered a liquidity stress metric. The hypothesis for this study is that the ratio of the central bank balance sheet and United States M2 money supply is a liquidity stress metric that can be used to predict a reversal in Fed policy from QT to QE or vice versa. Methodology. The ratio of the central bank balance sheet to United States M2 money supply is plotted on a TradingView chart with QE events marked. A Fibonacci channel is plotted using the outermost reaches of the ratio to establish the range. Whenever the ratio crosses above the 786 line, light red vertical line, or below the 236 line, light blue vertical line, in this range, the days are counted until the QE event occurs, green vertical line, or a QT policy is enacted, red vertical line. From this chart, we can make the following observations. 1. This ratio reaching an extreme value in the fib channel does indicate a reversal is likely coming within 2 years. 2. Inflection lengths are highly variable for both QE and QT transitions. 3. No clear trend is visible in the inflection length over time. 4. The best model for the current inflection length is the length of the previous transition to QE of 455 days. 5. A projection of this inflection length from the day of the crossdown puts the QE event on August 24th of 2026. Conclusions. The hypothesis is confirmed to be correct in the sense that an extreme value in this ratio does predict a Fed policy change. However, the tool is rough and does not allow for precise timing or projection with accuracy better than about 2 years. Therefore, this measure is best used as a positioning tool that can help show the current position in the capex cycle and give clues about how to position a portfolio in a rough 2-year time horizon. Possible explanations. A high ratio indicates oversupply of dollars and inflation risks, while a low ratio indicates liquidity and funding stress and deflationary or structural risks. Some possible problems with the study include 1. These two metrics may not fully capture the demand for funding and/or the possible sources of liquidity and should be taken as rough measures. 2. The global funding stress and liquidity may not fully coincide with the status of U.S. financial conditions. Some subjects for further study include 1. Identify more precise timing tools for the capex cycle. 2. Study behavior of capital markets in different parts of the capex cycle, e.g., market broadening versus concentration. The main outtake from this study is that if the ratio of the United States central bank balance sheet to USM2 reaches an extreme value, it can signal a Fed policy change is coming within a 2-year period. Not financial advice. Do your own research.